I guess I wanted to, and I don't have a lot of questions, but some of these dawned on me. And some of them, you guys see, you're probably smarter than I am. When I listen to some of this, it makes my head spin. But I know I've got to get it under my belt because it's important stuff. Tax rates right now, compared to, I don't know, anywhere in the last 50 years, are these really, really low, especially for high earners?
Yes, I think in the past, the federal income tax rate has been as high as close to 90%.
Yeah,
so if you think of it that way, it's very low.
Yeah, I actually thought that because I knew that was true. 90%, then you add the state tax, and you actually owe more than you possibly earned gross, which is gross, and I wonder why anybody would want to do that. And at some point, you just stop doing work, right, I think. But I don't think there's any doubt that there's going to be some higher taxes, and they're going to try and sneak it in. But one of the things that I've just kind of recently read is they are maybe going to minimize how much you can set aside in retirement vehicles. Is that something you guys have heard?
Yes.
Okay, unfortunately, there's no blueprint yet. There's sort of an intention to find some more chips to gather on their side of the table. And I've read the document on that combined Democrat-Republican group of people trying to get that done, and it seems like everything's fair game.
Yes. The comment that I have on that is that that's one of the reasons why I love real estate personally. And you see most financial planners or advisors typically aren't fond of directly owned real estate, but we are because of the depreciation, the professional real estate status, and what are the other things that you can do. And as strategists, we look at what are the alternative ways that you can do to minimize tax if they're going to be reducing the contribution limits on a retirement plan. So there are other solutions, other ways.
Some of the rules that did you want to make a comment?
Well,
Okay.
I was just going to say
Okay.
that I've read that too, where they may reduce the limits to about $2,000, take it back in time. But I also read that for an employer plan like a 401k, they're going to increase it to 17 from 16.5 to 17,000.
Okay. One of the taxes that you talked about, 3 point whatever it was percent, that starts at a certain number though, right? And it's in excess of what, 250? 250.
Yeah, 250 for married.
Okay, so that's where the wealthy start apparently, 250 and above. And the 0.9 is the same tax? Okay, not the same tax, but it kicks in at the same bracket? Okay. All right. How about you guys? You have some questions?
Karin, we belong to the Retirement Industry Trust Association, and the IRS and the Department of Labor has let us all know that they're really taking a look at IRAs. Can you talk about maybe some things that they're looking at, maybe some changes we should be watching out for?
Yeah, one of the things is that they're looking at valuations. And so I think that when it comes to a self-directed IRA, one of the things we're going to do every year is ask you what is the value of your asset. And I think that's an important letter to respond to. Sometimes it requires a stated value. Sometimes it requires a broker's opinion of value. If you're going to create a taxable event, for example, if you've got an asset in your IRA and you're going to liquidate it, you want to get and it's going to be a taxable event, you want to get an actual appraisal. But when it comes to the annual valuation, if you give us no valuation at all, what we're going to do is assume acquisition costs. But it's really important at least once every 3 years to report a correct valuation on your assets to your IRA custodian so they're correctly reported to the IRS.
Sure.
I was just going to say, we were talking earlier about Roth conversions. That same thing applies to that, because if you have a traditional IRA, that's self-directed account that's invested in alternative assets, the value isn't as easy as pulling up your broker statement, right? So if you're going to do a conversion, you need to know what the value is. You need to be able to support that, so that, because with the amount you convert, you're picking it up to income, et cetera, et cetera. So you do need to know and support what the value is. It's important.
Okay.
I just have a real quick story to share in terms of what the IRS is looking at. I actually had someone contact our office a few months ago, and he turns out he's an IRS audit agent. And if you guys didn't know, the people who work for the IRS, they are on automatic audit every single year. And this gentleman, he's interested in real estate, so he does self-directed investing with his wife through real estate. And the question, this is an honest question, he asked me was, with respect to prohibited transaction, Karen talked about don't put sweat equity into your properties. And the question he had for me and why he contacted us was, if I were to fix the toilet on my rental property, what's the likelihood that someone's gonna find out? And I thought that was very ironic because he was the IRS auditor. And so I asked the question back to him. And he said, you know, we really don't have a way of finding out. But I'm still not gonna do it, at least not until I retire from the IRS.
Good advice.
Today's effort, by the way, is about paying the least amount of tax possible legally and doing all these things correctly, because so many of the things that you can do inside of an IRA, what Karen mentioned, you think, okay, that has to be okay, and you find out it's not. Sometimes it being too late can be expensive. And also being able to keep most of your assets for your heirs to enjoy, but still doing good with it. To me, I just got a big kick out of knowing that was even possible. So I've got so much more to learn on that. You know, it's funny, I want to pay my fair share, I really do, and I think that's only fair. That's one of the problems Greece has, by the way. 70% of their doctors actually have recorded income as the minimum wage where you pay zero tax. So that's one of their problems, is they're not collecting any tax from wealthy people. And if you're in the tax whistleblowing business, it takes 14 years to prosecute a tax case. And if you blow the whistle, there's very likelihood that you are going to end up somehow managing to get to jail. So when you see all these people protesting, those are the W-2 wage earners that have no choice but to get their taxes doubled and get it taken out, while a lot of people don't pay a dime. So that's where the rub is. None of that effort is here. We're more than happy to pay our share, but we would like not to pay more than our share, if possible. Okay, we're opening up for questions. If you could raise your hand, we'll get a mic to you if there's anything else.
Aaron will run really fast.
Question down.
Right up front.
Of course.
Thanks. My question is to, I guess, Matt and Amanda. A lot of the strategies are for entrepreneurs. Would there be additional strategies if, for example, my wife and I are both W-2 employees and doing businesses on the side?
Yeah, a lot of these strategies can apply to your businesses that you're doing on the side. Now, you say on the side, now that may mean maybe it's a startup business, maybe it's in the early phases. But I think what I want to mention is a lot of people think they don't really treat those side businesses as quote-unquote businesses, but that's the mindset you have to have, is that these are real businesses. You are doing them. Now, granted, you may have a full-time job on the side, but you're doing your business at night, you're doing it on your lunch break at 5 in the morning, whatever the case is. But a lot of these things could apply to your situation. And just like Jim and Lorraine are talking about, these are options. Not everything's going to apply. So it is important to meet with your advisor and figure out what is the best way and what's going to make the most sense for your situation. But just because you're a W-2 earner and have a quote-unquote side business doesn't mean you can't implement some of these things.
I'd like to respond a little bit in that. If you think about Donald Trump, remember his bad comb-over? I'll guarantee that's tax deductible for him. And if he can get that tax deductible, what else is tax deductible?
I don't have a response to that one. I didn't know it was on. Okay.
There we go.
I have a question for Bruce. Bruce,
Yeah.
what do you think about rents in the future? Are they going up, down?
I think rents will probably be pretty strong where there's employment centers, and pretty weak, and not drastically weak, not really, because the demand is going to be so high. But in Orange County, for instance, I think you would have rents actually grow and go up. And I think you're finding builders very excited about building apartments there because that's exactly what they expect. I think you're going to have stable rents in a lot of other areas because of just the quantity of people leaving home ownership and going to rental real estate. You're going to have support. We don't have tremendous migration out of California because the problem of unemployment is pretty bad in a lot of other places where they normally would head. So they're staying here. So we're really not, I've had rentals in areas that got hit really hard in price. I haven't reduced rents one time yet. So, and I haven't had a vacancy. Now, it's maybe because we fix them nice, but by and large, and I can tell by our payment history on our program too. I mean, we've now lent $15 million in places from Lancaster to Hesperia and so forth. Everybody's making their payments because the rental has been successfully a positive cash flow. So I just don't see a big drastic change in that. Here I went hogging the mic.
Thank you guys so much. This has been really, really informative. Not everything that I've done, I'm really opening up here, has done very well compared to like doing things with the Norse Group. The Norse Group's awesome, but I didn't know about them all the time. So things I've done before, you know, the poo sort of hit the fan, right? And so when one wants to look at one's quote-unquote portfolio and do a strategy or do a plan, I'm just kind of like wondering, where does one start among you guys? Do you get with the tax person? Do you get with the, go ahead. And then also I had a question about what are some of the typical costs for putting a self-directed IRA with you and you know, a tax strategy or a financial strategy, just some typical costs to do that. Thanks.
Is my mic on? Okay, good.
Yeah,
well, I'll just hand
give
that.
it to me again. Huh?
There you go. You know, that's an excellent question. Where do I start? I honestly would suggest you start with us. As strategists, we will work with you to recognize where you're at, to organize what it is you've got, and then rebuild to where you want to go. And remember, we do not operate alone. We are a collaborative team. We're constantly calling these other people all the time to find out what's going on. And just to let you know, when you're working on this stuff, one of the things we're going to look to do is to try and harvest benefits from the poo that you've run into, okay? So that's one of the things that we think we do very, very well, because you never know what the tax situation is going to be, whether you've got IRAs that can now be converted because you've got some poo losses. Mm-hmm. By the way, is that a technical phrase on the tax return, poo losses? Yes. Okay.
Sounds as good as that other word you came up with.
Yeah, NIMCRUT, yes. Well.
I've got a question back here. 100% bonus depreciation. Does California conform to federal rules?
Excellent question.
Yeah, so the question is, does California conform to the federal rules in terms of bonus depreciation? And the answer is unfortunately no. California, obviously, as we all know, is striving for cash, so they're going to give you as little benefit as they need to. But having said that, California does allow some, I would say, look at other ways to accelerate write-offs and depreciation for equipment using Section 179. Now, there's a big write-off for federal for 179 as well that California doesn't go up to that limit, but California does give you a certain amount every year for that. So you got to look, at least do as much as you can, because there are things you can do, but unfortunately it's not as, you know, the benefit isn't going to be as huge as it is for Fed.
Okay. Karin?
I want Karin to have a chance to answer the first question, if it's okay.
Your question was, you wanted to know what it costs to self-direct an IRA? With our fees, you know, different companies charge different fee structures, but ours is a $50 to open an account. Our annual fee is $275 a year, and it's a flat fee, so that's regardless of the number of assets and regardless of the value. Also, too, there are transactions. You're going to, you know, obviously buy and sell assets and wire fees and things. We're going to waive your first 6 transaction fees for the life of your account.
Can I just say a comment about it? I just have to say that we work with self-directed accounts all the time, and I've done a lot of research. I've had self-directed accounts, and your fees are very, 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 very reasonable in comparison.
And just one comment, as a married man, I have no idea what a self-directed account is because she does it. We have a question
for
front.
Karin, really quick, another online. Is there a way to pay the taxes on a Roth conversion from within the IRA? Are there any other strategies to help pay these fees?
I'm going to let the tax expert answer the tax question.
Good
Here
call.
So the answer is yes, you can pay the conversion taxes from your retirement account, but we typically recommend that you don't, because one of the powers of having money in your retirement account is for that tax deferred or tax-free growth. So we work really hard every year to contribute as much as we can, because remember, when taxes are going up, we want to shift money from our personal funds into either the tax-deferred or tax-free bucket. So yes, if there's no other sources of funding to pay for that, you can do it. But I would suggest, for the audience member who was asking that question, to look at other strategies to reduce the taxes on the conversion. Like what Matt shared earlier, we have clients who are converting at very little or zero taxes. Okay.
I'm just curious, and I'm going to just interject because we're talking on the subject of Roth. When can you withdraw, and I don't know that you ever want to withdraw principal from Roth. I don't even know how that would work, but let's say I have money, I have a chunk of money in trust deeds, and I'm getting income, but it's just building inside the Roth. At what point can I just take the income and leave the trust deeds inside the Roth? And then all that income is, as long as the Roth has the principal, I gather the income is forever not taxable?
It's possible, and what I would say to that is that actually when you take money out of a Roth, the cool thing is that the money comes out, it's considered to come out of principal first. And so if you, in your situation, you're talking about bringing out income, which generally would be tax-free, but the cool thing is that principal comes out first. The other thing I'd mention too is that generally there's a 5-year waiting period. So whether you are contributing money to a Roth or you're converting money to a Roth, they both have 5-year waiting periods. So generally speaking, you got to wait 5 years if you want to pull principal out. But other than that, those are kind of the things that come to mind.
That hurts me to hear that principal out thing. I'm not used to that one. I don't want to touch the principal, but you're saying I'm not. It's just the
accounting thing.
Yeah, it's an accounting thing. You're not really touching the principal. It's just for tax purposes. It's considered as if you did. But it's better for you.
The other thing that I wanted to say is that if you're under 59 and a half, most people think they cannot withdraw from a retirement account when they're under 59 and a half, and the IRS allows, again, IRS code allows systematic equal periodic payments for a period of 5 years or till 59 and a half, which is ever longest, with no penalties.
Did you say no penalties?
No penalties. And so what happens is that we have people who may need the income from the notes or from the real estate because of their business or a situation. So there are about 5 different strategies to pull money out without penalties. And what's heartbreaking for us is that we see people just pulling money out and they don't know what they don't know.
Mm-hmm. Okay, Aaron, sorry, I don't need
Can I ask Bruce a pulse of the market type question to it? Because of the shadow inventory or whatever, are deals getting tougher at the courthouse steps in the Inland Empire or maybe on the MLS?
I think everything's got a tight margin right now as far as the lack of inventory has made the margins smaller, and you have a lot of people being able to buy for rental. So that's a whole different criteria. You're buying, instead of having a margin to resell, you're buying for marginal cash flow. We even pay full price for something and have a cash flow. And so if that's where the majority of the properties are going, that's where the challenge is some of our own are outbidding us because their intent is different. So it makes perfect sense. I'm not really worried about it because I think this ebbs and flows all the time. They try to find a happy mix. I think they're going to have more inventory because you had a natural clogging of the pipeline with MERS and all that stuff. There's going to be more inventory coming next year, but I just can't see a scenario where they just say, okay, let's open up the floodgate and get this over with. They could have done that 2 years ago and we'd have been better off. So I don't think that's their strategy.
Hi. You were talking about trust deeds in a self-directed retirement plan. Can you, if the retirement plan was a regular IRA and now it's self-directed, and then there's a trust deed in it where the person's doing a seller financed, am I saying this where you're up with me so far? I might be saying it kind of screwy.
Who are you talking to? I hope not me.
Okay. Okay.
That's why I handed her the mic.
It's a self-directed IRA. It was a regular IRA. It's self-directed. It now has a trust deed which seller financed. Didn't do the partnership thing. Didn't know about it. But can that, once the trust deed and the houses have already been sold within that self-directed retirement plan, can that be converted, or because there's been a sale of property you can't convert? Because it's a 5-year financing thing.
Okay, so are you asking if you can convert that asset to Roth?
Yes.
Okay.
If it
You,
made sense.
you can convert that asset to Roth before or after it's cash. If you want to convert the asset to Roth before it's, cashed out and paid in full, then what you need to do is get a valuation or an appraisal or what's called a valuation on the asset and convert at that rate. And then if it's cash, then you just convert the cash. And I'll let the tax experts discuss the tax ramifications of doing that, which, yeah.
It's nice
There
not to
wouldn't
be
any.
alone up
Yeah.
here.
Yeah, yeah.
I just wanted to add something about Roth because the power of a Roth is so strong. And what happens is we see so many people with IRA accounts, 401k rollovers, et cetera, and at 70 and a half, you're forced to have to take the money out. And in a Roth, there is no 70 and a half because it's tax-free. So there's no tax. But the IRS wants their money. And yes, we do pay our fair share of tax, but we want to take advantage of what they allow us to do. So looking at how much you should convert, looking at how you should convert your qualified retirement accounts to a Roth is very, very, very powerful for today and the future and for the next generation.
I think part of the strategy, too, is you have to realize that things are going to really radically change in the next year or two. So having a team that's their business. They'll go to weeks of school getting all the changes crammed in their head. You and I are not going to do that, and we're not going to understand what we hear in the first place. So it's good to have a team to kind of filter that through and go, okay, give me essence of change, please.
And the one thing I want to say is we often talk to people who, like Lorraine said, are of retirement age and they're forced to take money out where they don't really need the money. So one thing to take a look at, in addition to what we talked about with year-end planning, right, the risk-free trial offer to make the conversion and see where your investment goes. The other way to look at things also is if you are already needing to take required minimum distributions and pay taxes on that, why not instead do a Roth conversion? You're paying the taxes on it already anyways, but now instead of taking the money out, you've shifted that into the tax-free bucket for tax-free growth.
It's great to have a tax advisor.
Question, Dad, any thoughts on what the latest expansion of the HEART program will do to the market?
I think it'll have some effect. And that's a program where they're expanding the loan-to-value for refis. Sure, it'll have some effect. Is it unlimited or up to 150? 150% is what I understood.
I thought there was no negative equity cap.
There's no ceiling?
They still have to qualify, but I could be wrong.
Okay.
The full details are coming out November 15th.
Yeah, well, I'm not even sure the full details have been finalized. Certainly it'll make some sense. I think a lot of the people that are over 150% LTV are the group that haven't made a payment in a while. And I don't know that refining them, of course they wouldn't qualify because they haven't made a payment, their credit's damaged. It'll have a minimal effect, but it's not going to solve the problem. And, people that owe that much on the property are probably going to hand it back more often than they're not. And we still have a lot of that to go. We have 4,200,000 properties already 90 days late that wouldn't qualify. So if it solved every other problem, you still have 4,200,000 of that pile to get through, 1 million of which is in California. So at 500,000 property sales a year, we have a ways to go before we hit normal market.
Okay.
Okay?
Oh, one more.
One last question, I guess, okay? By the way, thank you very much for joining us. It's been a lot of fun to do, and it's been unusual in my head because I think, oh yeah, there's a whole bunch of people also watching this from their home. That's unique.
We've got a country that's got a horrible deficit problem and a government that can't pay its bills. I was just wondering if you heard from your industries if any of these allowances and programs will be adversely affected in the future.
I didn't hear the last part of it. Any allowances?
The allowances that we're talking about, the deductions, the IRS.
Right, okay.
Will any of these programs be affected in the future if there's any talk in your industries about that?
My guess would be the answer is yes. I mean, I'll just say it from my perspective, having read that document, that there will be some reduction of deductible interest. maybe go from $1 million to 500,000. At the end of the day, I think it's a moot point. I got to be honest with you. I don't think that's, in other words, whoever's going to buy a property from over $500,000 is either going to write a bigger check or they're going to compensate for what they're not netting as a tax benefit and pay less for the property. And I think it resolves itself pretty quickly. I actually feel the same way about the loan amount. You know, the big deal about reducing a $700,000 Fannie Mae loan amount down to whatever number it is, depending on the county you're in. Even in Riverside, when I think it's 400 and something, because of the price decline, the 400,000 loan serves more households than the 700,000 did. So, you know, it's like we're arm wrestling over something that's actually pretty meaningless. So now if they took the entire tax deduction away, and I asked this question to the group of people that went to the Susan G. Komen event, how many of you would not own a house because you didn't have a tax deduction? And that it wasn't going to affect ownership. It would probably affect price paid, but it wouldn't be, okay, well, we're not signing up for that anymore, because that's not why we own a property. You know, we own a property because we get to call the shots between the boundaries. And so I think it would be some adjustment. You know what? The truth is, real estate has to pay their fair share too. I guess that's where I come from. If we've got this big mess, our industry probably, I wish our leaders in the industry would probably say, you know what, we can sacrifice some of those things. And I'm with you as far as I've enjoyed a lot of the goodies. But does it really make sense to have a $500,000 tax-free sale every 2 years of a residence? Not that we get to enjoy that since prices aren't going up, but that's an astonishing accomplishment by a lobbyist. But I don't think it makes sense. Anyway.
Okay.